What are capitalized versus expensed project costs in SaaS finance? Imagine trying to track how much your company spends on developing new software features or tools. Some costs stay on your books as assets, while others hit your expenses right away. That's what we're exploring today. When a SaaS company invests in creating or improving software, the way those costs are recorded depends on what stage the project is in and what the costs are for. In SaaS finance, if you spend money on developing software that will benefit your business over many years, those costs are called capitalized project costs. They are recorded as assets on your balance sheet because they are expected to generate value in the future. Think of it like buying a new piece of equipment that will last 4 years. You don't expense the entire cost immediately. Instead, you spread out the expense over the useful life of the software through amortization. On the other hand, expensed project costs are those that are recognized right away on your profit and loss statement. These are usually costs that happen during the early stages of a project or after the software is ready for use. For example, costs related to planning, research, or initial prototyping are expensed because their future benefits are uncertain. Also, ongoing maintenance, bug fixes, or training after the software is live are expenses that do not add to the asset's value and are recognized immediately. Breaking down the software development process helps clarify this. During the preliminary or planning phase, costs like concept creation or feasibility studies are always expensed. Once the project reaches technological feasibility, meaning it's clear the software can be developed and will work, costs like coding, configuration, testing, and hardware setup can be capitalized. These costs are recorded as assets and then amortized over the software's expected useful life, which might be several years. After the software is launched and available for use, costs related to maintenance, updates, or user training are expensed. These do not add to the software's value but are necessary to keep it running smoothly. In the world of SaaS, accounting standards like the Financial Accounting Standards Boards ASC 35040 guide these rules. Because SaaS products often evolve quickly, companies must carefully decide when a feature or update qualifies for capitalization. For example, if a new feature takes several months to develop and costs a significant amount, it might be capitalized if it meets certain criteria. But if it's a minor update or ongoing maintenance, it's usually expensed. To manage this properly, SaaS finance teams often use detailed time tracking systems to record labor costs accurately. Clear policies are essential to decide when costs move from expensed to capitalized. This ensures compliance and consistency across financial reports. Remember, capitalized costs increase your assets and can improve short-term profitability because expenses are deferred. However, they also lead to higher future amortization expenses. Balancing capital expenditures and operational expenses is key for SaaS companies to stay financially flexible and transparent. Misclassifying costs can distort your financial metrics, affect budgeting, and influence how investors view your company. So, understanding the difference between capitalized and expensed project costs helps you produce accurate reports and make smarter strategic decisions. In summary, capitalized project costs are expenses that create a long-term asset, recorded during development after technological feasibility is confirmed. Expensed costs are those incurred before development begins or after the product is launched, reflecting immediate resource consumption. Properly distinguishing these costs ensures your financial statements accurately reflected your company's health and future potential.